Hello, welcome along to the Property Academy podcast by Opes Funders. I'm your host, Ed McKnight. And today on the show, we are talking about how to handle higher interest rates. Now, here's the thing. Interest rates are on the rise and it's going to impact your property investment cash flow. Now, the question is, well, how do you actually handle it? How do you respond? Well, let's first talk about what's happening to interest rates, because up until last week or 2 weeks ago, it would have been by the time this is released, every major bank in New Zealand, Kiwibank, ASB, BNZ, ANZ, and Westpac, they were all predicting, along with both the Treasury and the Reserve Bank, that inflation was going to come down, that price rises would slow down. But it was a very depressing week.
It was a somber week last week, wasn't it?
Because inflation was at 7.3%. And you can see here for the graph from you guys watching on YouTube, on average, all of those banks and the Treasury, the Reserve Bank, when you average out their predictions, they thought inflation was going to come in at about 6.6%. And the most conservative bank thought 7.1%. Now, Andrew, what did inflation actually come in at?
7.2.
7.2, 0.8 percentage points above the average of those consensus forecasts. And what that has done is it spooked the markets a bit, because it suggests that inflation will be around longer than initially predicted, longer than initially thought.
High inflation.
Higher inflation is what we're talking about here. But what I want to show you is what that has done to the bank's borrowing costs. So what has it done to wholesale interest rates? This is the rate at which the bank goes out and borrows money to then lend it to you and me. So that data came out, I think it was Tuesday the 18th. Let's take a look at what happened to that rate. Let's see how it went from 4.86% up to 5.2%. So it jumped by about 0.4% within about 2 to 3 days. It really spiked quickly, because the market suddenly thought, oh, inflation is going to be around for longer, the OCR is going to go up, so we're going to want more interest for the money that we're lending to the banks. Because of that, that pushed up the rates. So, Andrew, what has that done to the mortgage rates that the big banks are offering?
So your retail rates have gone up in line with these increases. So at the time of recording, ANZ have raised their interest rate, their 1 year interest rate, to 5.99. Westpac have lifted to 6% as well. Kiwibank to 5.89. Now, ASB and BNZ haven't followed yet. They're still at 5.5%, give or take, but they're likely to follow probably later on this week.
So most interest rates at the major banks have gone up by roughly, call it 0.5%. But what does that do to the cost of a mortgage?
So for an investor, for anyone, for an extra $100,000 worth of lending, that's another $500 worth of interest that you're going to have to pay a year. So for someone with an $800,000 investment mortgage, that's an extra $4,000 worth of interest per year. It's another $77 a week on top of what your top up was previously. So investors are going to have to put more money in to top up the cost of their investment properties. Now, just remember that it's not unusual for an investor to top up an investment property, particularly if they're buying now in a high interest rate environment, but those contributions might be getting to the point where you've got to kind of consider, how am I going to manage this with my other expenses that I've got in my lifestyle? And 27% of investors don't make a taxable profit, according to the IRD. But the question to you as an investor, how am I going to cover it? How am I going to cover the shortfall? And
we're going to get into that. But that calculation of about an extra $500 worth of interest per year, based on every 100K worth of mortgage that you have. So that's a really easy way to figure out, well, if I've got $300,000 worth of mortgage debt, what does this change? What is this change going to cost me? $1,500 a year.
$10 a week. $10 a week per 100K.
That's correct. So let's go through what those strategies are. Now, we have shared these before, probably about 200 episodes ago, roughly half a year ago, but I want to get even more practical. Now, strategy number one is to use a revolving credit. And what we mean by this is you might set up a $20,000 revolving credit against your main home, and you can use that available credit, that debt effectively, to finance your additional debt repayments. Effectively, what we're suggesting here is if your cash flow is going to be tight, use the equity in your house to finance those debt repayments. Now, bear in mind, we are talking about using more debt to finance debt and pay for debt. And you would, and long term, this would not be a good idea most of the time. No. This would only be used to get you through a period where interest rates are high before they come back down after inflation is tamed. And look, if we look at those consensus forecasts again, we can see that by about 2024, early 2024, you can see that most of those major institutions are predicting that inflation will be within that 1 to 3% band. So you'd only use it temporarily. Now, let's talk about how much you could actually use. So I've whipped up a wee spreadsheet for you. I tell you what, let's put it in the description. We'll let everybody have a play around with this, and I'll leave it all unlocked for you. But if you got a $20,000 revolving credit at a 7% interest rate, and let's say you said, I want to have this revolving credit, let me take some money out each week for 4 years, that would give you an extra $83 a week that you could use towards your investment property. And you could change all of these numbers. Let's say you could take out a $10,000 revolving credit and you wanted to look at what you could do for 2 years. Well, you could take out $90 a week for 2 years.
And just remember, the ideal situation is that when interest rates come down and you start to make a positive income from your property, you'd pay this back. So that would be a longer term strategy.
Yeah, you would definitely use the positive cash flow in the future to start to pay for these. What we'd actually typically see an investor do in this scenario is say, I am comfortable using $150 a week to top up my investment property. How big does my revolving credit then need to be? If I just put that in consistently every year, how much does it need to be to work itself out over the entire period?
And the latest return on investment calculator actually allows you to do that if you want to go into it in more detail, right?
That's right. opuspartners.co.nz/ROI. And if producer David reminds us, we'll put that in the description as well. So in this instance, let's call it a $10,000 revolving credit for 2 years. $90 is what we get out. Andrew, what's strategy number 2?
Is to reduce your personal mortgage payments. Now, according to Westpac, 68% of borrowers are ahead of their mortgage payments. So about 2 out of every 3 people are ahead of their mortgage payments. Now, again, long term, you want to be paying down your personal mortgage as quickly as possible. But if we're in an environment right now where we've got high interest rates for the next couple of years, why not slow down your mortgage payments temporarily? Now, let me give you an example with an investor that I'm working with. So, single income house with a $500K mortgage on a 15-year term. Now, this investor wants to free up another $120 a week to go towards an investment property because they're comfortable with the current lifestyle, but they're putting every last dollar into their mortgage. So what we've done in this instance, we've extended her term to 18.8 years, so an extra 3 years and 10 months. Now, does that mean she's going to pay off the mortgage more slowly? No, we're just going to pay this slower in the next few years, and then we'll speed up those payments again to make sure we still hit that 15-year goal of being mortgage-free. But by extending that 3 years and 10 months now, that's brought her mortgage payments down by $120 a week, which gives her enough to top up a property. And let's think about it this way. If doing that now and slowing it down, even if she never sped those payments up again, how much of an impact does owning a property and another property aside from the own home impact her financial future a bit more than that extra 3 years and 10 months?
And to be fair, it might add a little bit of time to the overall time it takes you to pay off the mortgage, because otherwise you have to make up the additional payments in the future.
But an investment property at 5% growth will have doubled in value in that time at a 5% capital growth rate.
But one other thing that an investor could do is actually push that term out to 30 years. That'd give her an extra $281 per week. Now, in effect, what would you typically do? You'd do the mortgage buster. You'd set up another revolving credit facility where you direct as much money in there as possible, and then when you need to, you can use some of that available to go towards the investment property. But we've got lots of other podcasts on that. So let's come down to strategy number 3, which is to reduce your KiwiSaver contributions. So I tell you what, I was on the blower to another investor, I think it was last week actually, and they had $180K worth of household income. So I think the female partner was on, I think it was $100K, and the guy was on $80K. So $180 in total, and they were both putting in 8% a year into their KiwiSaver. Now, that means they were putting away $14.4K, which is great. They were saving that amount of money, putting it into their KiwiSaver. And I said to them, one of the things they might like to consider is dropping that down to 3%. Now, that would mean that they could still get the employer contributions from KiwiSaver and the government contribution as well. But that would bring down what they were putting into KiwiSaver to 5.4K. That gives them an extra $9,000 per year in cash flow, which is a difference about $173 a week. Now, bear in mind, this is not without its trade-offs, because if you decrease the amount that you're putting into KiwiSaver, your KiwiSaver is not going to be as big when it comes to retirement. But you might think, well, I'm actually investing in something else. Arguably, that property could likely provide a much larger amount of capital for you at retirement based on our forward projections, because you're using leverage, and because that you might say, actually, I do want to take $173 a week that I'm putting into KiwiSaver and put it over here into the investment property to help ease that cash flow, even if it's just for the short term. In fact, I know, Andrew, some of your investors have stopped their KiwiSaver contributions entirely over the period of higher interest rates.
Just for this initial higher interest rate period, a lot of my investors don't see a major benefit of KiwiSaver over that couple of years compared to getting into the housing market right now when there's deals to be had.
Yeah, now bear in mind, of course, if you don't put anything into your KiwiSaver for those few years, you're going to miss out on the government contribution and the employer contribution, but you've got to weigh it all up to see what's the best decision for you. And what's strategy number 4?
Increase your income. So this is the earn, baby, earn strategy. Find ways to increase your income. And this might not just be negotiating a pay rise, but that's one of them. So right now, there's an absolute labour shortage in New Zealand. So a net 58% of employers say it's hard to find skilled workers. So now is the time, if you're going to ask for a pay rise, to ask for one. And if you're on 100K a year and you negotiate a 10% increase, so 10K salary increase, that's another $120 in your pocket every week after tax. Now, the other things that you could consider is review the rents on your existing rental properties. So last week, Ed increased rent on one of his rentals by $55 a week.
It was massively under-rented. So yeah, I talked to the property manager, gave notice, needs to come up to the market level. And actually, it might have even been $60 a week. Now, that sounds like a lot, but bear in mind that it is massively under-rented. That's what the market level really is.
And so that, based on his mortgage size, allows for a 1% rise in interest rates. Now, the other thing you could do is increase the cash flow on your rental properties by renovations or cash flow hacking or cabins. And there's an episode coming out in a couple of days on this. And then one of my favourites for people with older kids who is living at home, charge your kids board. So one of my investors, I said exactly this to them: work out what your contribution is going to be, go and tell the kids that they are paying board now, charge them exactly the amount it is that you need to get into your rental properties.
How many people that you work with would actually have adult children living with them?
Lots.
Really?
Yeah, lots.
And what sort of situations are they in?
Oh, you're going to university or something like that.
And they just happen to live with them?
Yeah.
Oh, how good. Charge your kids?
I did when I was at the bank. I paid $50 a week to Marie and John Nichols.
Yeah, but remember, that was back in the 1980s, mate. $50 a week would probably feed a family for a week back then. These days, it barely buys milk for the week. So let's just add it all up. Now, I haven't put in the earn, baby, earn strategy, but actually, I'll tell you what, I'm going to do it anyway.
What's up?
I'm going to call it $120 a week. Okay, so let's summarize this. If we add up everything that we've talked about, we said maybe you could get $90 a week through a revolving credit. Maybe you could get an extra $281 a week by changing the term of your personal mortgage. Maybe $173 a week from your KiwiSaver and $120 a week if you ask for that 10K pay rise. Now, all up, through all of the strategies we've talked about, and I haven't even included board here or increasing the rent and these kinds of things, we've found an extra $664 a week in cash flow. Now, bear in mind, some of the stuff you're spending on other investments already, but we're reallocating it. And so what are we trying to do? I guess I'm trying to encourage you to review where some of your money's going, but also review other sources of income that you could get to help you through this tougher time of cash flow with those higher interest rates. Because $664 a week,
it's covering most rental properties.
I'll definitely cover most rental properties and any further interest rate increases as well.
And I think it's just really important, again, to remember this is a short-term solution. This is not going to be the thing. I mean, the Earn Baby Earn's great because as soon as I'm working with an investor at the moment, Adam, and they needed a higher income for their servicing to work with the bank. went and asked his employer for an increase, just received an increase.
How much was it?
It was substantial. And not only is now a servicing pass, but now he's got extra disposable income, and that's forever. And, then you can make those tweaks with KiwiSaver and personal mortgage for the short term, or the revolving credit for the short term.
Rightio. And you might wonder, how do I apply these tactics to my portfolio? And I think it's really important to have a chat with either your mortgage advisor or your financial advisor to see, well, which ones of these could actually work for you. And if you are already working with a property partner here at Opus Partners, a financial advisor, hit them up and say, I'm thinking about the cash flow. What are the ways that I can apply these strategies to my portfolio? They'll walk you through it, no trouble. Right, let's wrap it up there, but please don't forget to rate, review, and subscribe to the Property Academy podcast. Really does help us get the message out to more people. And hey, we do have our upcoming book tour. We are completely sold out in Auckland, all 150 tickets gone, but we still have space in Christchurch and Wellington. However, it will sell out this week if it hasn't already. Links down in the description, along with the link for the other events in Havelock North and Queenstown. Really look forward to seeing you there. Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight. I'm going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most.